Steve Brown, it's been tough for REITs this year because of the expectation that the Fed will raise rates, and REITs are a yield alternative. Even though REITs haven't gone up, there's been a lot of pressure on the sector. But is it all about the Fed, or is there something more there?
It's a good question. I mean, REITs are down 3% year to date, so they've been impacted by the perception that the Fed wants to raise rates and move things higher from an interest rate perspective. I would say that's the bulk of the reason for the sell-off, because fundamentals are strong. Demand is still greater than supply in commercial real estate. We're seeing good earnings growth and good dividend growth among the REIT sector.
Well, one REIT you like is Avalonbay. It's up around 8% this year, so it is having a good year. It's having a hard time cracking that 180 level. What's it going to take to get it through?
Okay, Avalonbay is a play on the apartment space for us, and what we see going on is a big improvement in family formations. It's gone from, say, 800,000 a year to 1.5 million in the last year or so. As people have more confidence in their jobs, they're moving out of their house, and the first thing they move into is a rental apartment. Avalonbay has had great earnings this year. They're getting rent growth of 5–6% when inflation is only 2%. They're focused on the core cities like Boston, New York, Washington, San Francisco, Portland, and Los Angeles, where the job growth is, where the young people are moving to. So they're in a good situation. I think as we progress through the year, as they continue to show good earnings growth and have an outlook, their outlook for 2016, you'll go through that 180 barrier.
And you're also bullish on Douglas Emmett. They are big in California and Hawaii, pays a nice dividend. And it's actually up, I think it's around 2% so far this year. So is it going to remain sunny in Southern California for Douglas Emmett?
Yes, we think Douglas Emmett is a great way to play the recovery in Los Angeles. San Francisco has been in a recovery mode for the last 5 to 6 years. It's led the way with tech, et cetera. LA's economy is starting to pick up through technology, entertainment, arts, media, and the internet. And Douglas Emmett owns a Class A portfolio in West LA predominantly, as well as Hawaii. They're going to be the #1 beneficiary of the recovery, or the ongoing recovery of the LA office market.
All right, and then finally, you're a fan of Care Capital. This was spun off from Ventas not too long ago. They own nursing homes. Talk about Care Capital.
Care Capital was spun off by Ventas on August 15th. So the company and the assets have been around a while. They're focused on nursing homes, which are reimbursed by either Medicaid or Medicare. So it's a government reimbursement business. They came public, or spun off on August 15th with a great balance sheet, 25% debt to assets. They're going to be in acquisition mode. You can buy nursing home assets at 7, 8, 8.5% yield, and their cost of debt is only 4–4.5%. So it's a spread investing game, and they're going to have a lot of growth through asset acquisitions over the next 12 to 24 months.
All right, well, thanks a lot, Steve Brown.
Thank you.
And thank you for watching The Street.